Yes, thank you very much, Eberhard. Good afternoon. It's a great pleasure, really, to welcome you to this online meeting organized by our network, EconPol Europe. Most of you, but maybe not all of you, know that EconPol Europe is a network of research institutions in economics across Europe. And we are doing publications, conferences, and panel meetings like this one. And today is a very good day to have one of those meetings because the subject of this meeting today, the European Recovery Fund, is a very timely one. So yesterday, as you may know, the French and German government or the heads of state, Angela Merkel and Emmanuel Macron, presented their concept of the European Recovery Fund. And that makes it much more likely that it will come about. And it also gives it more form, so we know a few of the ideas of the German and French government. Of course, there are 27 governments in the EU that need to agree, but this is a very interesting point in time, I believe, to discuss the economics behind it. Now, it's a great pleasure and an honor, really, for me to welcome our guests. As was already said, we have with us today Professor Antonia Díaz she's Professor of Economics at Carlos III in Madrid. Her main areas of research are productivity analysis, climate change, inequality. So it's a broad body of research, and I'm very glad and very grateful to you, Antonia, for joining us today. So the idea of this meeting is to have, as Eva just said, a couple of presentations, but mainly, of course, to engage in debate. So you're all invited to send your questions, and that will hopefully generate a fruitful discussion. Okay, so I think we should start. Antonia, welcome again. The floor is yours.
Thank you very much. I'm very happy to be here and share my thoughts about this very important issue about this recovery fund. So let me just, for just 1 second, I want to share my slides. Let's see. So, all right. Okay. Here it is. So let me first remind you about what this coronavirus, this shock has meant to for us. So this is a very unlikely, tricky shock, and it's a supply shock. But it's different from in nature from any other shock that we've seen in the past. Basically, it's a shock to technologies that need physical closeness. So it's a shock for team production. But also in some other sectors, in which we need customer time as well as producer time in order to produce the services, say a restaurant, it's also a demand shock. But also, because it's an infection, that implies that in those technologies, in those sectors that are using limited space, I'm talking about factories, plants, shops, that's going to be a persistent shock because we will need some time to adapt to safe practice. So let me say it again, it's a negative externality. So that means that private agents do not internalize social cost of the shock. So it's a great example of a prisoner dilemma. And that's why public intervention is called into action. So all countries all governments are using targeted policies to keep the economy alive while in hibernation in order to prevent the massive infection in the population. But let me emphasize it again. The effect of the shock is not symmetric. Movie theaters are shut down, and Netflix is making a lot of profits because we are all watching movies there. So some sectors gain, some services cannot be provided with immune technologies. So along this phase of shutdown, governments are engaging in 3 types of expenditures. Covering guarantees to allow firms to postpone payments, so allowing risk sharing among firms, So we are assisting also firms with a state aid, so workers can stay idle or stay still at job. So one of the things that we've seen right now is a drop in hours worked, but employment is more or less stable. And we're also spending a lot of money in social protection, helping families to postpone mortgage payments, income assistance, etc. All this assistance will have to go beyond the shutdown. And it's because the reason I said, we need time to adapt to new and safe practices, work practices, so we don't get infected if there's still not a vaccine that can be used. So we are going to witness in Europe, in the European Union, a heterogeneous path of recovery. So the map that I have uploaded there is the map of the regions in Europe, and the colors are referring to different sector specialization. So as you can see, the pink areas in Spain, those are the services. So the thing is that the common market allows recurrent specialization across regions in Europe, and that's great, because each one of us can do whatever we are best at doing. But just because of that, that means that we're going to have different paths of recovery, because we are specializing in different sectors. So some countries will recover earlier than others from this shock. This also, what happens that countries with lower fiscal capacity risk facing losses of productive tissue. So a transitory shock may become a permanent shock. Overall, we are going to see huge increases in public debt across Europe. So the question is, why the European Union should act as an institution? And the thing is that the lack of coordination that we see in private agents when we have a negative externality also happens at the government level. Lack of policy coordination across Europe threatens the common market. An example, past attempts to ban exports of face masks by some European countries. But also direct state aid to firms depend on countries' fiscal capacity. So competition could be distorted. So the thing is that we need to enhance risk sharing across European Union members. So the table that I just put there is just showing you the amount of fiscal expenditures in which some countries have engaged already. So let's focus on Spain. So you see the huge difference between Spain and Germany. Well, we have a lower fiscal capacity, so we cannot respond as much as other countries are doing. Sorry. Second, why I think also the European Union should act? Because instability of public finance in a country, particularly in a country of the size of Spain, for instance, affects the Eurozone as a whole. And why is that? Because we do have a common currency, but we don't have a European treasury, meaning that we have uncoordinated fiscal policies. And don't get me wrong, I'm very happy, and I think it's very good we have an independent central bank, but I'm saying that we have uncoordinated fiscal policies. And the lack of a safe asset is a problem if we want to really grow as a global currency. And it's also a problem when we think about capital and banking market integration within the European Union. That is, we cannot reap the full benefits of being a global currency. And that's the picture that I took there from the discussion of Ricardo raised in the commemoration of the 20 years of euro. So the invoice of exports in euros had been falling since the crisis in 2011. So we would like to be a truly global, we have a truly global currency there. But the question is how the European Union should act. Let me say at the outset that I don't think that using the so-called euro or corona bonds, which is to say mutualizing debt across or among sovereign states, is a good idea. And I don't think it's a good idea because all the details about seniority are key, and the uncoordination of fiscal authorities creates a lot of moral hazard. Just give me, I'm going to give you an example. Suppose that the Spanish share of this new debt is considered as subordinated to the previous debt. So the new instrument perhaps has no great advantage with respect to other facilities that the European Union is giving. But if, on the contrary, all the Spanish debt is subordinated to the new one, which is something more difficult, Spain will have difficulties in raising debt on its own. In summary, I think that new forms of mutualized debt should not arrive in the middle of a crisis, and they should come after fiscal capacity of all European Union members is improved. Let me again talk a little bit about Spain. So we have all these funds agreed by the Eurogroup, the unemployment risk funds, these 100 billion facilities from the stability mechanism to 240. And the cost of the stability mechanism funds come with a margin of 45 basis points. So, and the thing is that good? I mean, is that reasonable? And the question is for us, could we on our own issue on total, say, 300 billion euros, which is about 24% of GDP of Spain in 2019? Why that number? In 2011, Spain issued almost 250 billion euros in the middle of the crisis. But that was the time in which we had so much worse market conditions and the risk premium was higher. So overall, I think that in the short run, the Eurogroup in this time has acted quickly. And I think that the funds that we have out there, they are going to give us a reasonable way of tackling with the issues of the shutdown phase that we have now. Now, let's think a little bit ahead of this short run. Let's think of the post-shutdown phase. So first of all, I would like to think about some lessons that we have learned from this crisis. And for one thing, I think that the abrupt disruption of global supply chains raises concerns about the benefits of globalization, and that's a problem. In particular, it looks like the size of the industrial sector seems key to fight against this pandemic shock. We need robust public health systems, but also health-related industries are proven to be essential activities. I think that national responses to all these challenges may endanger the common market and the aggregate benefits that it brings to all of us. So all these considerations will make us to reconsider the cost and benefits of active industrial policies. So I think that the recovery fund, and I will talk a little bit later about this, the size of the measures announced by or proposed by German and French government. I think it's an opportunity for coordination. We need to start discussing coordination of health measures and policies. We need to start discussing coordinated post-lockdown approach. For instance, there is a proposal of creating green light corridors, so it will be possible to fly from Berlin to Mallorca. That would be very good in order to share all the risk and mitigate the heterogeneity in paths of recovery. But also, I think, finally, we need to coordinate of our industrial policy. So I think that in order to really think of a recovery fund, we need to think of improving the European Union fiscal capacity. There are talks of improving the expenditure limit from 1% of GDP to 2% of GDP, and how we're going to fund it. I think it's the moment to think of a European corporate tax. So taxing digital firms, which by the way are benefiting a lot during this shutdown period. So we need to close taxation loopholes for multinational corporations, or eliminating fiscal competition between European Union members, and also thinking about carbon tax policies. So again, let me use Spain as an example. Much of the low fiscal capacity in Spain comes from loopholes in corporate income taxation. What if large firms pay taxes directly to a European tax agency? That would be much better. Or let's think, the proposed size of the recovery fund is 500 billion. Suppose that the European Union actually issues bonds, and the service of those bonds is 1% annually. That would generate a service of 5 billion euros annually. That's exactly the estimated revenues of a digital tax at 3%, as shown in the proposal of a fair taxation in the digital economy. And it's also, I think, it's an opportunity to enhance risk sharing across US members. Perhaps later on in the future, we want to phase out the income-based contributions to the multi-annual financial framework and replace it with a European corporate tax. The revenues can be used to finance this recovery fund. And I think that the recovery fund should be, and at least they are saying so, should be targeted towards sectors and regions more affected. And I think it should be integrated within the main programs funded by the European Union, which is a tested framework to allocate our resources. So those are my thoughts about the issue. Thank you very much for your attention.
Thank you very much. Now we have room for a couple of clarifying questions, and everybody is invited to join in here. Let me start with one question to you, Antonia. You showed these numbers about what the countries do, how much money they mobilize, and you said there are limitations for some countries because they have no fiscal space. But what's striking is that Italy spends as much in relation to its GDP as Germany. And Spain doesn't spend very much. So although, at least if you look at the debt to GDP ratio, it's much lower in Spain than in Italy. How do you explain that? And could you maybe share with us some aspects of the debate in Spain? So how is this crisis discussed, and how is the debate about the fact that the government seems to be doing much less than in other countries?
I think that our government is taking very seriously this issue. I mean, we've learned the lesson from 2008. So the main worry here now in Spain is that we don't want to have the risk sovereign premium to go up. So I think that's why the emphasis is in the risk sharing measures. So the government is committing all these guarantees for firms to risk share among them. So because the main problem that I see here is that the real activities stopped, but the financial activities is going on. So we could have a whole moratorium in financial activities, we will be much better. But that's very difficult in an uncoordinated world. So that's why we're putting the full emphasis in there. Why? Because if we manage to do that well, we will actually need to do less in actual spending. So that's my reading of what the government is doing.
Okay, so still it's a significant difference. But Eberhard, do we have reactions from people out there?
Yes, we have one anonymous question from the audience. So one attendee says, Professor Díaz mentions bold steps in terms of green technologies in her presentation. I think you mentioned it shortly. How far should these bold steps go in her opinion? Should support also be linked to some sort of green industries?
Yeah, I think so. In my view, that I would put the emphasis in the carbon tax. I mean, there is this proposal in the US of creating this carbon tax dividend. I like more, we could discuss more the dividend, is like putting this tax in the origin, in the refineries, in the firms that are bringing the dirty technologies, the fossil fuel energy into the economy. And we should do that. But of course, later on, we should implement that with a broad approach of how to green our economies. And I think that because if we had to borrow, if we had to issue debt in order to finance all this pandemic shock, we better do it in a way that the next generations get a better world from us.
There's just another question coming in from Joost Kuhlmann. I apologize if I mispronounce any names. Mr. or Mrs. Kuhlmann says, it was argued that there were loopholes in the Spanish CIT system and that tax collection by a European agency would solve the problem. But one thing is the CIT system and another one who collects. If there are loopholes in the CIT system, would the first best not be to close those loopholes?
I think that the size of the corporations that we have now all over the world imply that we need to have a joint approach to corporate taxation. And actually there are thoughts about that in the European Commission. There is this initiative called the Common Corporate Tax Base, which is a first step towards that, meaning that creating the same using uniform way of taxing corporations within Europe, so firms cannot get fiscal advantages from shifting profits from one country to another one. So saying that, yeah, of course we could improve our tax system in Spain, but doing it by ourselves is not going to be the answer.
I have one last question from Jon Imbrescu. How intense can be the fiscal policy harmonization? Quite general question, I think.
Oof. That's an economic and also a political issue, isn't it? Because I can say as an economist, what I think is would be the first best, even the second best, but I wouldn't dare to go further than that for the moment.
Okay, there's another question just coming in. I was interested from Agnes Benassi-Quer. She's writing, I was interested in the sector specialization argument. Is there a case for a recovery fund in the size of the gains from intra-EU industry specialization? Otherwise, there is a risk that each country comes back to old-fashioned industrial policy.
That's why I think we need to think about industrial policy in a coordinated fashion within for the whole European Union, because what we see now, there are signs that are hinting to countries thinking about industrial policy, but in a coordinated way, and that's like we know that's inefficient, isn't it?
Okay, so I think that's it for the moment. I would suggest we continue with the presentation of Professor Fuest, and then in the end, we still have enough time to continue with the Q&A and questions and the discussion. Mr. Fuest, please.
Okay, thank you very much. Now, in my presentation, I would like to focus more on this idea of the recovery fund and other measures. Let me just try to share. So, can you see the slides?
Yes.
Yes.
Well, that's great. That's okay. I just have to figure out. Okay, I get it. Okay, so let me go back to the challenges we are currently facing, although Antonia mentioned a couple of them, so this will be repetitive to some extent. So the key challenge, obviously, is to stabilize the economy in this situation. And this is, of course, primarily with our institutional setup, is primarily a task for the member states. And what they do is, as was said earlier, in like phase one of this crisis, help the economy to survive the shutdown. So help employees, self-employed people, companies, and so on, give them liquidity. And then we will have a phase 2 where support for the economy after the end of the shutdown is necessary. So we need to get the economy moving again. Of course, there is a continuum between the shutdown and the time after the shutdown. But the more we open up, the more it makes sense to get to support the economy in order to get it going again. Now, as Antonia said, one of the consequences of this crisis is a massive expansion of public debt. And I think we need to be aware of the fact that the conditions under which we are entering this crisis are not very benign. So first of all, there is very limited scope for monetary policy action. Yes, some kind of short-term financial aid can be provided. We can, change the conditions for the refinancing of banks. The ECB can buy government bonds. But crucially, it cannot cut interest rates, or it could cut them a little bit into the negative. But the impact on the economy is much less certain than if we look back to the financial crisis. In the financial crisis, we had room for interest rate cuts. We don't have that now. Then fiscal policy is also in relatively bad shape in many member states because the debt levels are much higher than they were before the financial crisis. So we haven't managed to bring down the debt ratios, with some exceptions, and that makes it more difficult. What makes it easier in a way is that interest rates are also lower now. So this takes off pressure, has taken off pressure of national budgets in the past. And there is a lot to suggest that interest rates will remain low. So in a way, this is good news in this crisis. So this increases fiscal room at least a little bit. Now we have the Eurogroup decisions of the 9th of April. They've been mentioned already. So all countries will have access to the ESM, to a credit line of approximately 2% of GDP. There is the European Investment Bank that will provide financing for small and medium-sized enterprises, and we have the SURE program, which basically generates loans to member states if they want to use the money for short-term work and other things, stabilizing the labor market. These are more traditional instruments. And now we have something new here, the European Recovery Fund. And as I mentioned in the introduction, yesterday, the French and the German government came up with some ideas about what this fund really might be. So I haven't been able to bring the details of these proposals into this presentation, but it's not so, there's no big surprise. So a lot of what I'll have to say actually fits the French-German proposal quite well. So maybe very briefly about this idea of Corona bonds, just because it was discussed so much. My reading, in fact, of this initiative towards Corona bonds was that it was more like many things in Europe that end up not working, that this initiative was motivated by domestic policy issues. So if 9 countries in the Eurozone publish a letter suggesting something they know the other countries don't want, they don't expect the other countries to agree. But I think it was probably more important for them to give a domestic signal, like, we are doing something, or we're trying to convince our partners. But it was a rather unhappy initiative in the sense that it increased the tensions and it was doomed to fail from the beginning. It was a rather vague proposal, so it wasn't entirely clear who would issue these bonds. There is no institution that can issue these bonds. It wasn't entirely clear whether Euro area countries would be jointly and severally liable, or how that would work, and how the money would be distributed. I think the advantages of these proposals have already been mentioned. So there's a certain interest in the creating of a liquid asset. Maybe it could have provided some relief on highly indebted states, although there is this issue Antonia mentioned about the seniority of these of this debt versus national debt and so on. So it's not entirely clear how helpful the Corona bonds would really be in this crisis. The disadvantages have also been mentioned. So countries would be liable, but it's not clear whether they would have any control over the use of the funds. This would at least need to be specified. And one very critical question was, would we have to create a new institution for issuing these Corona bonds? If we had to do that, this would last years, and the crisis would probably be over before we had that. The EU summit of the 23rd of April definitely rejected this idea and instead came up with this idea of a European recovery fund to be anchored in the EU budget. So I think the first thing to understand is that this recovery fund is not an instrument to address the current downturn. It will come a lot later. It's an instrument for the recovery, but it is not something to address the current downturn. The legal basis is to be, if I understand this correctly, Article 122. Article 122 doesn't talk about that. But it does talk about union fiscal assistance to the member states. So apparently that is, at least that's what, or I haven't heard any lawyers up to now. They will be coming forward surely, but I haven't heard anyone saying this is impossible with the treaties recovery fund, even if it includes some debt funds. Okay, so what is this European Recovery Fund? The idea is that the EU takes on debt and gives money to the member states. And one debate is, will this be a transfer? Will this be a loan? Or will it be used, will this money be used for European programs? So no transfer to member states at all, and no loans, but used for European programs. So the volume that was first debated was 1,500 billion, 10% roughly of EU GDP. What's now been put on the table by the French and German government is 500 billion, which is 1/3 of that. So that would be roughly 3%, a bit more than 3% of GDP. So what's the money for? Here is a statement by Charles Michel, the Council President. He said this fund shall be of sufficient magnitude and targeted towards the sectors and geographical parts of Europe most affected. And that's related also to what Antonia said about the different specialization of regions and sectors. So how about the financing? So it's very important to understand that the EU cannot really issue appropriately rated debt because it doesn't have the power to tax. The EU is not something like a federation with a central government that would have the power to tax. So that's why the member states need to guarantee this debt. And they will come up with guarantees probably according to GNI. So the same key which is used for financing the European budget, or at least a large part of it, will be used to finance this debt. So guarantees are needed. And the European Commission is to develop the concept and also how the money will be used. So I would like to focus on the question of what this recovery fund can really achieve and how it will be financed. So first of all, what can it achieve? In a way, I think it's unfortunate that we have started discussing about raising a lot of money even before we have thought about what we will do with this money. And the critics, I think, are right in raising this question. So what can this fund achieve? So as economists, we would say one thing this fund could offer, if it is a response to the crisis, is insurance. So insurance is a well-established economic concept. If different regions happen to suffer different economic losses as a result of the crisis, and if these losses are not visible yet today, the fund can have the character of an insurance policy. Then you could think of this fund addressing international spillovers in the fight against the pandemic. So if one country takes action against the epidemic, other countries will benefit, or depending on the action may be harmed. So there are spillovers. The trouble is the fund is too late for that. So everything will be done before this fund comes into action, unless the pandemic stays for a long time, which would be bad. But it's unlikely that this will be in the center of the fund. Then what this fund could achieve is what I call solidarity here. So my understanding of solidarity is not just redistribution or transfer. My understanding of solidarity is, I like the following definition. So solidarity means you take the problems of your neighbors as your problems. You consider them as your problems. So in many ways, I think that's true in Europe. We know, for instance, that if the industry in northern Italy does not open up, it's not just an Italian problem, it's a German problem, it's an Austrian problem, because for instance, our car industry gets a lot of parts from northern Italy. So very simply, if industry in northern Italy doesn't open up, we have a problem. So the Italian crisis is our problem as well. So even if we already knew who will be most affected, I think with this concept of solidarity, it makes sense to do something jointly about it and maybe use the fund if it does help. Now, does the fund help? Maybe not for this particular problem, but possibly for other problems. Then there could be a cohesion objective, redistribution towards poorer member states. Now we have policies in that regard, so maybe that shouldn't be the focus of the fund, although we will see in a minute that it's hard to think that cohesion will not enter the use of the money in this fund. And then in theory, we could finance new EU policies. Crucial for this policy would be that we create some added value. And I think this is generally the key question here. If we want to justify this fund, we need to demonstrate that it creates added value, relative to the same money being spent by the member states. We need to demonstrate that we can do something here at the European level that the member states doing individually cannot do, because this debt is, of course, the debt of the member states. They will have to service the debt through their contributions to the EU budget. There's no doubt about that. So the question is, if it's their debt, if they have to service it anyway, they have to give the guarantees, they need to service it. Why do we gain if we send money to Brussels and get it back again? I think that's a key thing we need to show, to convince those who are critical that this fund makes sense. Now, I've done a little back of the envelope calculation for this European Recovery Fund, and just to ask what does it generate in terms of insurance, and what would the redistributive effects be across member states? And the idea here is that okay, we have 1,500 billion euros we put into this fund. And we, in this back of the envelope calculation, I have considered three types of expenditures. The first would be insurance. So if this is an insurance against the effects of the crisis, you could say, okay, EU member states receive transfers from this fund depending on the economic losses due to the corona crisis. And what I've taken here is we don't know those losses, which in a way is good news, because we want some uncertainty for insurance to work. But I've taken the IMF forecast from April to calculate the GDP decline in 2020. You can also look at the expected decline until 2021. And you could say, okay, it's an insurance. So you get more if you have a higher than average decline. And if your decline is below average, you pay into the fund. It's an insurance device across EU member states. Then you can put in a cohesion objective, redistribute part of the funds to the poorer countries, or you can take away a part of the money and let it go to new EU policies. Now, if you look at this insurance motivation, there is, if you like, a slight problem, which you see in this graph. So this is the forecasted GDP loss in France, Germany, Italy, and Spain, forecasted by the IMF. And what you see here, it looks the same. So if this forecast is true, there will be, yes, small differences. So the prediction for Spain is 9 plus something loss of GDP. For Germany, it's just 8.2 or whatever. But this is all within the margins of error. I mean, there is a perception that Germany will be less affected. I have to say, I'm not convinced. No country among these four is as exposed to international trade as Germany, and international trade is disrupted. If we look back to the financial crisis, Germany in 2009 was the country most affected, or among the country. I think Italy also had a negative growth of close to 6%. I don't quite remember the Spanish number, but Germany was very badly affected. So I really think we currently do not know which country will be most affected. And that also means if everybody is affected symmetrically, insurance doesn't make much sense. Okay, we cannot insure ourselves if we are all affected in the same way. Then we end up paying for ourselves, so it doesn't really help. Of course, we don't know that. And in a way, for insurance, that's a good thing, because we can still write an insurance contract. So if it is this insurance, let's look at this fund. So what you see here is simply the net balance. So we pay in, I've assumed here, we pay in proportionally to GNI. Hence we pay into the EU budget. And we get back money in proportion to our economic losses in this crisis. And so you can look at the different countries. Germany, for instance, the predicted economic loss for Germany is slightly lower than average. Germany is a large country. That's why Germany would contribute 2% of its GDP, a bit more than 2% of its GDP to this fund. So Germany would be a net contributor. France would be a net contributor. Belgium, Malta, but then also, unfortunately, a country like Bulgaria or Hungary would also be a contributor. Spain, the forecasts for Spain is so negative that Spain would be a net recipient here. But Italy, for instance, would be a net contributor. I don't know if the Italian government expects a fund where Italy will be a net contributor. I don't know. But I think this just shows that a pure insurance model probably doesn't work. Not because Italy is a net contributor or Germany, but because Bulgaria and Hungary will not accept a fund where they have to finance the debt and pay money, for instance, to Spain, which is a much more well-off country, or even to Ireland. Ireland has a very negative forecasted GDP effect. Ireland would get a lot of money. One of the richest countries in the EU would get a lot of money out of this fund. The Netherlands should love the European Recovery Fund if it is an insurance model, because at least currently their predicted loss in GDP is far above average, so they would get money. Italy would pay money to the Netherlands if it's a pure insurance model, and if the shock materializes as predicted by the IMF. And I don't think that that's politically acceptable. I think more generally, if we think about this being an insurance, we have to accept the fact that governments will not know, do they get money out of this or do they have to put in money? And does the German or the Italian government want to run the risk that Germany and Italy are going to pay money to the Netherlands, a very rich country, and to Ireland? I don't know, frankly. So let's take a look. I mean, if it's not insurance, if it's not transfer to the member states, what else could be financed here? I think whatever the new EU programs are, as I mentioned in the beginning, it's key to show that there is some value added of European versus national provision. As I said, insurance would create added value. It's not something you cannot create insurance just on the national level. Solidarity as well, but that needs to be explained. Then there are European public goods. You could think of financing defense, migration policy. There's a lot of things we could do jointly in Europe, better than individually. The problem is they all need permanent funding. And this is a one-time funding, at least that's how it's announced. It'll be difficult to convince people that this is not one-time funding. Cohesion policy we already have in the budget. European infrastructure would be something that would be very useful. Invest more into border crossing infrastructures. That would be one way, a productive way of using those funds. European industrial policy, I think that's more complicated. and in a way, it's difficult to pin down what it actually is. Let me maybe say a few more words about European industrial policy. There is a lot of talk in the context of this fund about European industries being affected and so on. There's also a lot of talk about greening, about the Green Deal and making the economy green. I really think the key challenge here is to demonstrate that in the end you create some added value and you are not just giving money to lobby groups, because a large part of industrial policy is exactly that, giving money to established industries who have strong lobbies, and I think that is a real danger we are facing here. Let me conclude. The corona crisis, as we all know, is very serious. There's a high forecasting uncertainty. This is something that isn't exclusively bad. I think the Eurozone has addressed issues of investor panic and liquidity of member states quite well, so there is no problem at the moment on that front. But about the recovery after the crisis, that is a real challenge, and the European Recovery Fund is supposed to help. I think that the European Recovery Fund has potential. I think it's a good and important idea, and if it is carried out properly, it can be very useful, but making sure it is a challenge. One thing that will not be solved by this is the debt sustainability problem of Italy in particular. It's not an instrument that will solve this problem. We need to understand this. But it may help the whole of Europe, including Italy, that yes. And as I said, we need to ensure that some added value is created by this policy at the European level. And my taste is that we should really focus on investments here that are not carried out in the private sector, that would not be carried out by the member states. But we need to focus on investments like European infrastructure, so border crossing infrastructures, research, maybe something like a European DARPA, so radical innovation financed at the European level. I think if it's going into that direction, it can really be fruitful. Thank you. I'll stop here.
Thank you very much. I would like to open the floor. So at some point, it would be nice to know how your back of the envelope numbers, because I think it's important when to think about heterogeneity within countries, isn't it? Because you were talking about the global supply chain. You know, Germany is a very open country, so whenever things go bad in Italy, the car industry getting into problems in Germany. So do you have all that degrees of heterogeneity within countries when you're talking about insurance?
This is a very simple calculation. Really back of the envelope. I just calculate, what is GNI, and so what do countries put into this? And what do they get back? And of course, if it was only about that, we wouldn't have to do it, because it would be a zero-sum game. I mean, the underlying assumption is that the insurance effect, if we achieve one, doesn't really change much. It's insurance, but maybe more for consumption smoothing. And it will not lift up anyone. But I mean, we will have these debates. It's quite clear. So people will look at these financial flows, and I think the only good answer to this question, why do we send money to Brussels and then get it back? And maybe some of the poorer member states are net contributors. We need to face that. Why should we do that? And the only meaningful answer can be that there is some added value created, and it's not at all trivial to demonstrate that this is really happening. And I think we really need to focus on that and convince people, yes, we are creating something useful here. Okay, so do we?
Okay, let's maybe come to some audience question. I have one question from Mr. Heinz Handler. He's asking, what would be an economically satisfying way out of the impasse between the French-German position on the European Recovery Fund and the so-called Frugal Four?
Very good question, yes. Antonia, do you want to address that question, or should I give it a start?
You start there.
Because I'm probably, at least I live closer to the Frugal Four. Okay. Yes, I think it's precisely that. We need to demonstrate also to the Frugal Four, to the Netherlands, to Austria, and so on, that it is in their interest. So it will be impossible to convince people that they should pay for the problem of others. Why should they? Europe does have a degree of solidarity, but that's enshrined in the EU budget. And here we are asking for twice the amount in the future. And in these countries, people are saying, why should we pay more? I mean, we are already net contributors. Why should we pay more? And the answer has to be, it is in your interest. The answer cannot be, it's something you should just give money to other people. I think the answer, the message needs to be, it is in your interest. Why? And then they will ask, why can it ever be in our interest? And then we need to, or those who defend this fund need to demonstrate that some value added will be created. And where does it come from? And I would say maybe it does come from border crossing infrastructures. Maybe it comes from investments in the different member states that support the economic recovery, although I think it will be difficult to convince the Frugal Four that the mere fact that this fund helps recovery in other countries should be good for them. They would certainly agree it is good to an extent because, their customers are living in these countries, but is it really enough? That will be hard to demonstrate, and that's why I think we really need to show that we are doing investments that are profitable and that wouldn't be carried out by the member states themselves. If we don't manage to do that, we will not convince the Frugal Four, and we need to convince them, I believe, to say, okay, these are not just going to be loans. This is money, this is fiscal spending in the EU budget. I wouldn't like to call it transfers. This is just spending in the EU budget on meaningful things.
There's another question from an anonymous attendee who came up with the idea. What about the idea that the fund would provide incentives to carry out structural reforms? Could that be an EU added value?
What was that?
It was the idea to say, okay, let's use this money and offer countries incentives to carry out reform. What do you think, Antonia?
Let's see. I think that on the one hand, it looks like we are taking the euro for granted. And one of the things, the way I'm looking into this recovery fund is that we are learning some of the lessons that we learned from the Great Recession, which was the general instability in the euro area. And I think that this issue about, as you were saying, insurance it has a great value added in there, which is that I was talking about the euro as a global currency. And we thought about in creating a common currency because we thought it was great to have a global currency to really conduct our monetary policy, shielding our activity against the movements in interest rates in other countries. And we thought it was the great idea there was shielding our common trade against changes, shocks to the interest rate, exchange rates. But also, I think that the gains from the monetary union, there are some things that come. There are some costs, but there are also some gains. And it looks now that some people do not gain from really following the logic of the monetary union. So yeah, we're trying to say there are some risk-sharing principles in there, because I believe that risk-sharing is not just also within countries, is within regions and across members of people of the same different countries. So that's, I want to say that. So when we are measuring the gains of ensuring across different European Union countries, we should take into account that whole heterogeneity. That being said, me personally, I'm not against giving conditionality because to some funds, because I believe in incentives. Okay. But the thing is that we really need to think about incentives in a good way, creating value in the long run. So it's not used to, as what happened in the Great Recession, I want some austerity measures, I want to cut investment in health expenditures or etc. Because we're seeing now that perhaps we were cutting investment in sectors and in areas that are essential. So when thinking about this conditionality, I think it's fine, but we need to do it in an intelligent way and looking in the medium long run. That's what I would say.
Thank you. Maybe I can follow up on that, because I think it's a very interesting question. So, and this takes me to, in fact, a study by EconPol Europe we published some time ago. The context there was about EU regional policy. And now what we said there is basically that there is, in a way, a tradition in the EU to preach to countries and tell countries what they should do. So there's the European semester. This is not about preaching, it's more a conversation among the member states, and I personally find it very useful. But there is the perception that Brussels tells the member states to engage in structural reform, and structural reform itself has always become negatively connotated because people associate with it austerity and so on. And maybe, so what you suggest in your question is something else, and that's something we tried to come up with and describe in this EconPol study. We suggested that countries can come up themselves with a plan to, about how they want to develop their growth. Why? Because ownership of reforms. That people are really convinced that this is a way they can go, and they want to go towards more prosperity. So the idea was that people can go to Brussels with member states can go to Brussels with a reform plan and put a plan on the table towards more prosperity and more inclusive growth and so on. And there would be a negotiation, and if there is agreement between the Commission, the Parliament, and the member states, the partners, that this is a good plan, this would be supported. So the way would not be Brussels or other countries telling the country you have to do this and that, and people feel oppressed. It would be a plan coming from the country, really, an offer. And Brussels could say, we are not convinced, we don't finance this. But hopefully the conversation would also lead to a common plan. But the roots of this plan are in the member states. And if countries don't grow, if the countries don't achieve their objectives, they lose the money. So the incentives are there, but hopefully the ownership of the reform would be different. So I think it's a very good idea. It would be something new. At the more general level, I think it is problematic to come up with this notion that people in Brussels or wherever know better what's good for a country than in the countries themselves. I think that's dangerous. And I think here the idea is it comes from the countries themselves. And I think that's very positive.
I don't think, should I? Well,
please.
I don't think when we go to Brussels, the way we want to think about Brussels is the place where we all talk, we all conversate and discuss our ideas. And you put the emphasis on coordination of policies, because that's exactly the value added that we can get. I mean, coordinating and not predating is the way of creating value added. A lot of increasing returns to scale in putting up some coordinated policies. And that's why I was using the example of corporate taxation. And because it's where our, I would say, with the new technologies, where we have these huge firms there. And well, basically they're not really paying that much taxes. So it's there. And if we really want to do that, to tax all these digital firms, we should do it together.
I think that's a grand idea, but corp taxation is the core of national sovereignty. And I mean, it's interesting you mentioned that. The European Commission has spent 50 years trying countries to convince to cooperate in corporate taxation. France and Germany have had an initiative for years to cooperate, and it hasn't worked. So it's interesting, but it's good not to give up. I agree.
Well, the thing is that we are giving is like some percentage of the VAT revenues to finance the European budget. So we agreed on that. Is not that surrounding part of your fiscal sovereignty?
Well, I mean, it is an artificial calculation. We don't give, it's true, we have some coordination of the value-added tax. So we don't tax as, we want nationally, but that is necessary to have a common market. But in fact, the VAT own resources are an artificial calculation. They are not a certain percentage. So, and indirect tax is even more, that seems to be more, I think you are right. If you look at this, 27 tax systems. So companies operating in Europe have to understand and deal with 27 tax systems. It's really very complicated. It's inevitably the case that it leads to inconsistency and so on. So a lot of people would be better off if we manage to get away from that. But at the same time, I mean, this raises many issues, I think, in the end, including the question of who determines, let's say, the corporate tax rate. Who is it? If it's not the national parliaments, it needs to be the European Parliament. And that would require a power to tax. And the power to tax is really at the heart of sovereignty. And that's my understanding why it's so difficult to make any progress.
I know, but it's interesting that, at some point we surrounded our monetary sovereignty. So there was some logic in doing that, I guess. And that's because we thought there were some things to gain from that. And the thing is that I do believe that, as I said, the global currency, euro, if you really want to have the full benefits of that, we need a safe asset. We want to have that safe asset. We need to have some fiscal capacity at the European Union level. And for that to be efficient, we need some coordination. That's economic logic. And of course, I agree with you. Economic logic has different timing many times from political logic. But
let's return. That's a very fundamental debate, but very important one. And if we look at how monetary policy last point is conducted in Europe, I think we are facing almost daily. We are facing this tension. We have a common currency, but we are not a federation. We don't have a federal government. And that creates tensions. But we should return to questions from the participants.
Right. So there's one question from Heinz Handler, which I think fits quite good in the debate regarding fiscal coordination and the question who determines what. He's asking, shouldn't payments out of the recovery fund be disconnected from specific member states, but rather linked to projects, for instance, creating public goods wherever they are located? The funds perhaps be allocated by an independent fiscal board. So the funds can perhaps be allocated by an independent fiscal board.
Do you have a view on that, Antonia? Or
yeah, that's the second best. I don't know exactly what to say now about that. But that's an option that I really need to think about that, because
I think so. First of all, I would very much agree that if this fund finances public goods, European public goods, let's take as an example a European cybersecurity agency. We currently have one, but it's a very small one, and it's not allowed to do anything. So it's located in Greece. It's not allowed to do anything. So if we had a proper European cybersecurity agency, we shouldn't ask where is it located, but we should, we should fund it, and it provides a public good which is to the benefit of all of us. So it's the same with European border protection and so on. So if we are providing European public goods, it doesn't really make sense to ask which member state gets what, because it's about European public goods. So in that regard, I fully agree. I do not think, though, that the European Fiscal Board can make these decisions. They have to be made by, we are no expertocracy. I don't know if that word exists in English. We are not ruled by experts. I think that legitimacy is extremely important. So I'm afraid the European Parliament, the member states have to be involved, the European Council need to take those decisions. Of course, that's where it gets tricky, because especially the member states have their national interests and will always say, so I want the agency in my country, and so on. But so I think we cannot replace decisions by parliaments and governments just by letting experts decide. That doesn't work. But I totally agree, we need to get away from this view that the only interesting thing we are getting out of the EU is a net balance. If it was all a zero-sum game, we would better stop it. But we need to spend on things where we all benefit. And European public goods is a very good example. Do we have other comments or?
So there's another question from Willem Sass. What if we would correct the insurance mechanism for the fiscal space available or used in each member state, referring to the argument that, for instance, Germany or France are spending more already than Italy or Spain to caution the shock, hence risking further economic divergence?
I would have, thanks, Willem. I would have to think about that, but my first reaction would be it creates moral hazard, does it? So, you punish the countries that have done a lot. Until very recently, it's interesting, everybody was pressing, in particular Germany, to spend more to stabilize the economy. Now Germany is spending more to stabilize the economy, and people don't like it. Of course, the idea was before that what people like is that the expectation that Germany imports more, and here what's going on is different. I'm aware of that, but I have to think about that. But my concern would be that it would distort decision making. It could even make countries wait for this fund, do nothing, and hope for money to come. So I would be worried, but I don't claim I fully thought this through. Antonia, what do you think? Spain would get a lot of money then, would it?
Well, I don't know. I mean, as I said, the thing is that in Spain, basically, we are worried about our level of public debt. So we just want to manage that. So the thing is that if we are maybe getting a deficit of 10% of GDP, and we need to raise our public debt. So that puts us in a very difficult situation.
So do you think the money from the fund should be going to countries like Spain that are worried about their own national debt? And I think that's what Willem proposes. Let's give the money, because Spain hasn't done anything. Let's give them the money so they do more.
I think, to tell you the truth, what I think is that the recovery fund should, as I said, should go to help sectors to adjust to this post-pandemic shock. And I think that it should be given to sound policies. And I believe that as a byproduct, we will get a stable public finance. As a byproduct. So, exactly. So I would say that the focus should be in, as I said, in financing sectors that need it, in regions that need it, to really create the good gains from coordinating all this policy in the European Union. I don't think that the focus should be given to that per se to the countries that have high public debt, because I agree with you, that creates a moral hazard problem.
Please, any other comments from the audience? Or
yes, so Spain and the Spanish perspective is maybe a good keyword. Sean Smith wants to know, Professor Díaz, what can you say about tourism in Spain? What do you expect from Brussels regarding tourism revival after Corona?
From Brussels. You mean, what I would like first, as I said, is to work in coordination policies in the post-shutdown phase. That's why I was talking about these green light corridors and being able to open up regions that are doing well in terms of the pandemic. So in Spain, for instance, we have in Andalusia, in the South Spain, or in Mallorca and in Canary Islands, they are much better off than Madrid or in Catalonia in terms of controlling the health problems. So it could be a good idea to try to coordinate so we could really open up these regions that happen to be more specialized in tourism. So at the same time that we need perhaps to finance those activities for a while, so firms do not shut down and there's a general breakdown in the economy. But at the same time, we are allowing the economy to recover as fast as possible.
So I have two questions still open, but I think we still have time for a few more. The user Nam was asking, do you expect an L shape of economic development in the EU? According to EU's experience, the redistribution-oriented EU policy has been less successful. Is there any possibility to create a rather proactive, growth-orientated policy to come out from the crisis, or too late? Question mark.
Should I go?
Please.
First of all, what I would like to say is that there is we have all these forecasts about the drop in GDP, and there is a huge uncertainty about that. We have all this, say in Spain, that the forecast of a GDP drop in this year of almost 10%, and that's huge. And I hope that there are some little signs there that maybe we not end up with such a big drop in GDP, okay? So that's the first thing that I would like to say. So and I think that whatever we do now in the way of coordinating and organizing the post-shutdown phase, and so we can get back in the activity going, I think it's going to be determinant to see what type of recovery we're going to have. Or faster, etc. So to me, actually, that's the most important thing right now. So, Clemens.
Yes, thank you. I mean, maybe I can add a question to this question, also to you. I think it would be interesting to discuss a little bit what policies we might pursue. Now, assume we focused the recovery fund on the sectors, as you suggest. So we would leave the member state perspective and we would say, okay, we have sectors in Europe. We have tourism, we have the car industry badly affected. We have other sectors, the airlines badly affected. So one wonders, what would these policies actually do? Because these, I mean, you could say, okay, these are private companies, they should invest or not invest. There is no way there's no market failure here, so there is no way of improving on that, on their investment decisions. Maybe they have some financing problems, but this is private investment. So the question is, would be, so let's look at the car industry to make this concrete. We have all these car companies in Europe. They have a lot of money from past profits. They are focused on the combustion engine. They are in structural change. So what is it that Europe should do? Should we give them money? Should we do a premium? There's this debate about a car scrappage premium. Should it only be for electric cars? Or so what are concrete policies?
As I said, it would be nice to look in just into sectors, particularly sectors that are more linked to the rest of the economy. Those when we're thinking the input-output sense. But even within sectors, I agree with you that we should be thinking about different firms according to their size. I agree with you that it's not the same thing. A big firm that have a lot of profit, a lot of collateral, and can raise money from the rest of the economy, and that shouldn't be treated in the same way as a starting firm or young firm investing in new technologies. Ideally, you would like the government to care more about sustaining these firms. These starters than those that have, let's say, a lot of collateral. Mm-hmm. And I agree with you one thing, that of course, that at the end of the day, it's a private business. But shutdown is a different thing from closing down. I mean, it's stopping for a while, that's fine. But the point is, whenever you're destroying intangible firms, and when you destroy a lot of intangibles of firms, considering they have a lot of increasing scales around, that's a problem. And that's why governments are actually coming and stepping in, trying to capitalize firms, isn't it?
Okay, so what you have in mind is give firms capital, give them loans, or give them buy even participations in private firms, or?
I would say that this is the more ready instrument now we have in Europe. I mean, ideally, what I would like to have is a deeper equity market in Europe, isn't it?
Yeah.
So they are not so much dependent on the banking and on the banking system, but that's kind of a longer term problem, and we cannot do it just now. So.
Okay.
So perhaps with an eye on the clock, we still have time to discuss two more questions. I want to continue with one question which was submitted via mail in advance from Dr. Jon Imbrescu. He wants to know how will you image the intra-EU mobility of the labor force in the post-pandemic period? it will be counted that during the COVID-19 pandemic, Romanian workers cannot be employed in Romanian farms, but they can work in German asparagus farms.
I think this is an example of an uncoordination policy, isn't it? To me, that's why I think that we will need a little bit of coordination in this recovery phase. But aside from that, I don't know what would be the good policy for.
Yeah, I agree. So what we've seen in this crisis is that countries have unilaterally open borders or closed borders. There was this story indeed of flying workers into Germany for different types of harvests, including the famous asparagus. And this is something that should be coordinated. I fully agree, and it's certainly not optimal if countries decide, in a discretionary manner.
That maybe perfectly brings us to the last and final question I have from the user Nam. Don't we need to more adequately consider also the global competition against the US, China, and so on when making policy decisions?
That's why I was talking about a coordinated industrial policy, because all the issues that we're discussing with all the problems with US and China, they boil down to industrial matters. But and I really think that that's also one reason why I need to coordinate. Okay.
Yes, I mean, I agree. I think in many areas we need to, of course, take into account this competition. If we talk about, at a very general level, about sovereignty in Europe, I think one thing we need to understand is that often we do not face the choice between national sovereignty and European sovereignty. If we think about our relations to China and the US, we have the choice between European sovereignty and no sovereignty at all. For instance, if we think about trade agreements with China, if we can use the leverage of the European internal market, we can achieve something. But nationally, if the European countries are divided, there is very little to achieve. We have made this experience in the conflict about tariffs with the United States, where the United States would have loved to separate the Europeans. For instance, put a tax on, let's say, German cars and force other countries to let agricultural products come in from the US. So here it was very important that this was a European competence. At the same time, I think we need to bear in mind, if we talk, as we did earlier, about corporate taxation, we need to understand that we are in a global competition for capital. And we also need to understand, if we think about things like the digital tax, it's an idea that seems to be coming back. If we unilaterally introduce a digital tax, it's a declaration of war on the US, and they will respond with tariffs. That's why I personally think we shouldn't do that. It's too costly. We don't want to start another trade war with the US. So I think at both of these levels, at the level of companies and of course of policies, we need to understand that we have these partners and competitors, the US and China, and Europe is either a player in many of these things at the European level or no player at all.
So with that said, I would like to close the Q&A for today, and maybe give Professor Fuest the final words of today's event.
Yes, okay. So first of all, I would like to thank you all participants and all who have contributed for being here. In particular, I would like to thank you, Antonia, for your presentation and for your discussion. It's wonderful that you took the time to to be here with us today. I would like to thank all of you for your questions. I think this was really a very fruitful debate. We could go on, but I think we should stick to the time. So thanks to all of you, and do take a look from time to time at the EconPol webpage and at our activities. It's really worth it. So thanks for your time. Have a nice evening and goodbye.
Well, thank you very much to all. Thanks for the invitation.
Thank you. Goodbye.